Not all dividend portfolios are built to survive a storm. Some crumble when the market crashes, cutting payouts, slashing income, and leaving you scrambling. In this video, we're breaking down exactly how to build a recession-proof dividend portfolio. You'll discover the sectors that hold up, the companies that thrive under pressure, and the red flags that warn you before it's too late. This isn't guesswork. It's a strategy for long-term financial stability, because when the market shakes, your income shouldn't. Part 1. What if your income didn't crash with the market? It's 2008, and the S&P 500 just collapsed by more than 50%. Most investors watched their portfolios shrink in real time, devastated. Well, here's the twist. While the world was melting down in 2008, Johnson & Johnson actually increased its dividend by more than 10%. That means, while everyone else was losing money, Johnson & Johnson shareholders were getting a raise. Let that sink in. More cash in the middle of a financial crisis. But before you start snapping up dividend stocks, there's one massive mistake that trips up most investors, and it could cost you thousands in lost income. Part 2. The dividend danger most investors ignore. All right, let's talk about something that traps more dividend investors than anything else. High yields that look too good to be true. You've seen the headlines, right? Get 10% a year. This one stock pays you while you sleep. Sounds amazing. Free money, right? But here's the brutal truth. Chasing sky-high dividend yields is one of the fastest ways to destroy your passive income. Here's why. A company offering an 8, 9, or 10% dividend often has serious problems under the surface, like shrinking profits, rising debt, or collapsing business models. And when trouble hits, guess what's the first thing to go? The dividend. Look back at 2008. Bank of America was one of the darlings of dividend investing, 64 cents per share, paid quarterly. Until suddenly, it wasn't. They slashed it all the way down to a single penny. Gone. Just like that. Or fast forward to 2020. Airline stocks like Delta and American Airlines were paying investors handsomely, until the pandemic grounded everything. Their dividends? Completely suspended. Indefinitely. And it didn't stop with airlines. Many REITs, especially in retail or office space, cut or canceled their payouts too. Even companies that looked solid before the crisis buckled under pressure. Here's the bottom line. High yield often equals high risk. And in a recession or downturn, that risk shows up right where it hurts. The cash you were counting on. So what do you do instead? You stop chasing the flash and you start building something solid. Because smart dividend investors know, it's not about how high the yield is. It's about how safe and sustainable it is. So the question becomes, how do you actually spot a recession-proof dividend stock? What should you be looking for before you invest a single dollar? Let's break that down next. Part 3. What a recession-proof dividend stock looks like. So, how do you find a dividend stock that laughs in the face of a recession? I am talking about the kind of company that keeps paying you, month after month, no matter what chaos is hitting Wall Street. It is not luck. It is not magic. It comes down to a proven checklist. 4 critical traits that separate reliable income machines from dividend disasters. Trait number 1. Consistent cash flow. Forget accounting smoke and mirrors. We want companies that generate real cash year after year. Because here is the truth. Dividends do not come from accounting profits. They come from actual cash in the bank. If a company's cash flow is unstable, your income becomes unstable too. Especially during a recession. You want dependable, boring, repeatable cash flow. That is your dividend fuel. Trait number 2. Low debt. Debt is like an anchor during a storm. In good times, it might help a company grow. But when things get tough, that same debt can sink the ship. High interest payments, limited flexibility, and pressure from creditors, it all adds up to dividend risk. We want companies with strong balance sheets, not ones that owe money to everyone in town. Trait number 3, a recession-resistant industry. Think about it. What do people keep spending money on no matter what? Food, medicine, electricity, soap. These are non-negotiables. So we target companies in sectors like consumer staples, healthcare, and utilities, where demand stays strong even when everyone else is cutting back. Trait number 4, a long history of dividend increases. Not just paying a dividend, but growing it. Through recessions, through pandemics, through every market meltdown you can name. A company that raises its dividend year after year is telling you something powerful. We are built to last. Look for decades, not just a few lucky years. Put those 4 traits together: consistent cash flow, low debt, recession-proof industry, and a long dividend growth track record, and you've got a company that is built to pay you in good times and bad. But let's not just talk theory. Let's look at the real-world test. Who actually survived the worst of 2008 and 2020, and who didn't? You're about to find out. Part 4. Lessons from 2008 and 2020. Who survived and who didn't. All right, it is time to move from theory to the real world. Let us put this dividend strategy to the ultimate test. The financial crisis of 2008 and the pandemic crash of 2020. 2 brutal economic storms that crushed portfolios, rattled investors, and forced companies to show what they were really made of. So, who survived? Who kept paying dividends? And who completely fell apart? Let's start with the winners. Johnson & Johnson. In 2008, while the S&P 500 dropped over 50%, Johnson & Johnson raised its dividend. In 2009, another raise. Fast forward to 2020, right in the middle of a global shutdown. They raised it again. No panic, no excuses. Just steady, reliable income. Now, look at Procter & Gamble. Same story. They did not just maintain their dividend. They grew it. Year after year, recession or not. That is what a fortress dividend stock looks like. But not everyone was built that way. General Electric was once a Wall Street darling. In 2008, it cut its dividend by 68%. And that was just the beginning. More cuts followed in the years after, from dividend star to income disaster. Then we have Ford. In 2020, they completely suspended their dividend. Not reduced, not adjusted, just gone. And airlines? Delta, American, they were paying dividends pre-pandemic. But when travel collapsed, so did their payouts, zeroed out. The difference between winners and losers is not subtle. It is massive. So now that we know who survives the storm, let's talk about where to build your foundation. Part 5. Building the portfolio. Sectors that hold up in a storm. Let's start with sector number 1, consumer staples. These are the products people grab at the grocery store, whether the market is booming or crashing. Soap, toothpaste, soda, snacks. Things folks keep buying because they need them, not because the economy is great. Think Procter & Gamble, the maker of brands like Tide, Pampers, and Gillette. Their products are in homes across America and around the world every single day. Or Coca-Cola. People do not give up their Coke just because there is a recession. These companies have incredibly stable sales, and that means stable dividends. Sector number 2, utilities. When the economy takes a nosedive, do people stop paying their electric bill? Nope. Whether it is a boom or a bust, the lights have to stay on. That means steady cash flow for companies like NextEra Energy, a leader in clean energy, or Duke Energy, a massive utility with a long history of solid dividend payments. These companies are not flashy, but they are dependable. And dependable is exactly what we want in a storm. And sector number 3, healthcare. People will cut vacations, cancel gym memberships, and skip dining out. But they will not skip doctor visits or stop buying medicine. That makes healthcare one of the most recession-resistant sectors around. Giants like Johnson & Johnson or Merck continue to see demand even when the economy slows down. These companies often have strong pipelines, consistent revenue, and a track record of increasing dividends through tough times. Now here is the thing. You do not have to pick individual stocks if that feels overwhelming. You can get instant diversification through ETFs. For consumer staples, check out XLP. For utilities, look at XLU. And for healthcare, XLV is a solid choice. These ETFs spread your investment across multiple reliable companies in each sector, minimizing risk while keeping the income coming in. So you are building your foundation in storm-proof sectors. That is smart. But what could tear your portfolio down just as fast? Up next, the biggest psychological mistakes dividend investors make during bear markets and how to avoid them. Part 6. Avoid these common mistakes in a recession. Mistake number 1. Emotional selling. Picture this. The market is down 20%. Every financial news outlet is screaming, recession, layoffs, market crash. And your portfolio? Bleeding red. Your instinct? Hit the sell button. But here is the problem. Selling during a crash is like jumping off a roller coaster mid-ride. You lock in your losses and miss the recovery. History shows the market has always bounced back, and if you are not in the game when it does, you lose the upside. So breathe, zoom out, stick to the plan. Mistake number 2. Chasing crisis yields. During bear markets, a weird thing happens. Some low-quality stocks suddenly show juicy dividend yields. 7%, 8%, even 10%. Tempting, right? But here is the danger. Many of those companies are struggling and might cut their dividend the second things get worse. Do not fall for the bait. A high yield means nothing if the company slashes the payout. Stick to quality companies with strong fundamentals, not just high numbers that look good on paper. Mistake number 3. Turning off your DRIP. Your DRIP, Dividend Reinvestment Plan, is a secret weapon. When stocks are down, your dividends buy more shares. That means more future dividends. That is compounding in overdrive. Turning off your DRIP during a bear market is like refusing a discount on your favorite stock. And now, let's put this all to the test. What if you had built this kind of portfolio before the 2008 crash? What would your income look like today? Part 7. What this portfolio would have earned since 2008. What if you had actually built this type of portfolio back in 2008? Now remember, 2008 was brutal. The market tanked. The S&P 500 got sliced in half. But guess what did not get cut in half? Dividend income from the right companies. Let's say you put $10,000 into a blend of ETFs like XLP, XLU, and XLV. The big 3-sector ETFs for staples, utilities, and healthcare. Companies inside those ETFs include giants like Johnson & Johnson, Procter & Gamble, and Duke Energy. These were not just companies that survived the meltdown. They actually increased their dividends through it. So what would your $10,000 look like today? In 2025, it would be worth more than 4 times your original investment. Plus, you would be collecting dividends every month. If you've made it this far, I've got something special just for you. A free dividend survival guide built to help you create an income stream that can stand strong through any crash. Inside, you'll get a checklist of recession-resistant sectors, key dividend safety metrics to watch, and a 10-year income forecast worksheet you can start using today. Want it? Just comment, Dividend Shield on this video. Once we hit 50 comments, I'll drop the link so everyone can download it and start building a stronger, smarter portfolio. So now you know how to build a dividend portfolio that can survive any crash. But what happens when you actually retire and need to start living off that income? In the next video, we'll show you exactly how to flip the switch, from growing your dividends to using them. You'll learn how to transition your portfolio, time your withdrawals, and still keep your income flowing strong. Click over now to learn how to turn your portfolio into a paycheck without running out of money.